Hello, this is Rochelle Agatha, and this is Chapter 12 lecture, Completion of the Accounting Cycle for a Merchandise Company. So we've made it through all 12 chapters at this point. So the learning objectives for this chapter are to prepare financial statements for the merchandise company, to record the adjusting and closing entries, and to prepare the post-closing trial balance, and then complete any reversing entries if applicable. So let's prepare financial statements first. To complete the accounting cycle, these are the steps. You prepare the financial reports, then you do the income statement first, the statement of owner's equity, and the classified balance sheet. And you need to do them in order so that you get what you need for each statement. Journalize and post any adjusting and closing entries, and then prepare a post-closing trial balance, which you'll see is what rolls forward to the next period, and then do any reversing entries. Why is this important? These steps are important so that you get ready for the next accounting period. So the income statement. Companies want to know what were its net sales, what was the level of returns of goods from dissatisfied customers, which is why we kept them in a separate account, what was the cost of goods brought into the store versus the selling price received, how many goods were returned to suppliers, what is the cost of goods that have not been sold, and what was the cost of the freight. So these are typical things that companies want to know. So that's why we have the income statement. Here's a partial income statement so that you can see that you have your gross sales, less your sales returns and allowances, and your sales discounts gives you your net sales. So this we learned in a previous chapter. So this is what it looks like on the income statement. Then your cost of goods sold, if you're not keeping track on a perpetual system, you're forcing the purchases and returns, etc., through the income statement so that you can see it. So here's your cost of goods sold is your beginning inventory, plus your purchases, less your purchase discounts, purchase returns and allowances is your net purchases. Add any freight in, and then you get your net cost of purchases. You add the beginning inventory plus your net cost of purchases, and you get your cost of goods available for sale. Then you back out your ending inventory, and that is your cost of goods sold. So take a look at this and print this slide out because it's actually very methodical. And as you were doing the entries throughout the chapters, it might have seemed more piecemeal, but when you look and you stand back and you look at the income statement and you think about the entries you were making, it makes sense that you had this beginning inventory. Then you bought stuff. Maybe you got a discount, maybe you returned. Then that gives you this net amount that you purchased. Then you had freight that you were responsible for. And then that gives you the most that you could sell is your beginning plus what you purchased. That is the maximum goods available for sale. So when you think about when you go to buy your iPhone at the Apple store and they don't have any, it's because their beginning inventory plus their purchases or what they manufactured isn't more than what the need is out there. So that it makes sense to look at it like this. When you subtract your cost of goods sold from your net sales, that is your gross profit before any other expenses. Your operating expenses, as we learned, were broken into categories, your selling and your administrative. So in a merchandising company, it's important to understand which costs are directly related to the product itself and which expenses are administrative in nature. So here's your partial income statement of all of your operating expenses. So you have your salaries, your payroll tax, depreciation expense on the store equipment, supplies, insurance, postage, etc. And here's your total operating expenses. So your net income from operations is your gross profit less your total operating expenses. And then you might have some other income and other expenses to give you bottom line net income. You need to do the income statement to then do the owner's equity statement. This statement reveals changes in capital. The information comes from the worksheet that we learned, and the ending capital figure is therefore transferred to the balance sheet. So first the income statement, then the owner's equity statement. The statement of owner's equity is checks for additional investment, increases or decreases from profits and losses, and any withdrawals. So let's take a look. Looking at your partial worksheet from previous chapters, we did the worksheet. So you can see that there's net income. There may have been a capital infusion into the company or a withdrawal. So when you come down here, you have your beginning capital, plus or minus any net income or loss, less any withdrawals, and that net is your increase in capital, and that gives you your ending capital. This is the balance that will transfer to your balance sheet. The classified balance sheet provides more detail for assets and liabilities. It provides stakeholders with information about their ability to pay current and long-term debts, and it provides a more complete financial picture. Current assets, cash and assets that will turn over within 1 year, are considered current assets. The operating cycle is the time it takes to buy and sell merchandise and then collect on accounts receivable. So the reason that stakeholders want to see current assets is so that they can measure current assets against current liabilities for cash flow and liquidity. They are listed in the order of how easily they can be converted into cash, and that is what liquidity means, how easily something can be converted into cash. So when you look at a balance sheet and you become familiar with balance sheets, you'll notice cash is always the first one. It's not in order of how big numbers are, it's in order of liquidity. Cash is being most liquid. Theoretically, accounts receivable can be paid off sooner than merchandise inventory can be turned over. Then you have supplies and prepaid insurance. This is a typical current assets section of the balance sheet. Long-lived assets are used in the production or sale of goods or services. The shortest lived assets are listed first, and then they're shown with their contra account. Remember accumulated depreciation, that word contra account? It's an asset, but it has a negative balance. Here's your current assets. Here's your plant and equipment section. So you put the equipment with the contra account to get net assets. So you have your store equipment less your accumulated depreciation is your net, and then you get total assets by adding the two together. Current liabilities are debts or obligations that must be paid within 1 year or one operating cycle, similar to current assets. They're listed in the order that we expect to pay them, and the current portion of long-term debt is moved to the current liability section. Why is this important? So that anyone looking at your financials can see if you have enough cash to pay off your short-term debt. So here's your current portion of your mortgage payable. Typically, AP is the first one listed. This book puts the mortgage payable first. Typically, AP is first. Then all of your payroll liabilities, and then unearned rent and mortgage payable. Long-term liabilities are not due and payable for a comparatively long period, more than 1 year, and the current portion, as mentioned, is under the current liability section. So here's all your current liabilities previously reviewed. Then you have the big mortgage payable down below. Our objective 2 is recording, adjusting, and closing entries. Journalizing and posting adjusting entries. Adjustments on the worksheet are not in the journal or the ledger at the time the worksheet's prepared, so they need to be reflected back into the accounting records. So here was your trial balance, and here were your adjustments that were made throughout the chapter. And remember that your income summary collected what flowed through to net income based on the adjustments that were being made. And we took our beginning inventory and our ending inventory and reflected them through merchandise inventory and through income summary. So we did this previous to get the worksheet so we could do our financials. Now we're trying to go back and book them into the books. So here's just the look in the T accounts. So you can see where all the entries are coming from. Journalizing and posting adjusting entries. So now you can see when you actually go to book them, all of your adjusting entries have to be booked in your books. So there's your inventory going in and out of income summary, your unearned rent, supplies expense. These all carried over from the previous chapters, so from the worksheet that we learned. Here's what they look like in T accounts. Once again, these slides are really beneficial if you print them out and you're listening along and you're following the examples in the book. Then you have to journalize and post the closing entries. And why is this important? Because you have to get your books ready for all of your temporary accounts. Your temporary accounts clear out so that they can think of that glass half full thing. So you have your cup or your glass every period and you need to fill it up, and then you empty it so that you can start over again. You close all balances on the income statement credit column except the income summary. Then the credit total is carried to the income summary. Then you close all balances on the income statement debit column, except the income summary, by crediting them, and then that total debit runs to the income summary. Then you transfer the balance of the income summary account to the capital. Then you transfer the balance of the owner's withdrawals to the capital. Notice withdrawals do not go through income summary because they do not affect net income. You will close your credits through income summary, close your debits through income summary, revenues, expenses, close the income summary net income to capital, then close withdrawals straight to capital. It's very methodical. So here's what it looks like in journal entry format. You're debiting all of your revenue or all of your credit accounts into income summary. Then you're crediting all of your debit accounts into income summary. Notice you have these two entries here. Then you're going to close the net of your income summary to capital. Then you're going to close withdrawals to capital. So it's a 4-step process here. Then you prepare your post-closing trial balance. And this is a stubby little trial balance. It's prepared from the general ledger. You want to make sure everything's in balance before you move forward to the next period and see that all temporary accounts have been closed. Notice here it is. It doesn't have any temporary accounts on it. It's all your permanent accounts. It's in balance and you know you're ready to begin the next period. Then you want to do any reversing entries. And this they call it the optional section. I've worked in a lot of businesses, and the reversing entries, depending on what kind of accounting system you use, sometimes they're set to automatically reverse. They're typically reversed into the next period, and depending on who is running your company, sometimes this is the first step in the new month or it's the final step in the current month. And as I mentioned, it is a bookkeeping technique, and it depends on what kind of system you're using and how you want to do it. But basically, all you're doing is taking any accruals that you made, and then you're reversing them so you start from scratch. So remember those entries we made to accrue wages through the end of a month, or that payroll that fell between 2 months, you want to reverse it so that when the payroll entry comes, it hits properly. That's the best example for this. So here you see the adjusting entry was salary expense, salary payable, and then it closed back through. Without the reversing entry, you may end up out of balance when the real payroll actually hits. So you can see it coming through. Reversing results in switching the adjustments on the first day of the new period, and each of the accounts ends up with the same balance no matter which method is chosen. So whether you do it at the end or at the beginning. Reversing results in switching the adjustment the first day of the new period. So here's your salary payable and your salary expense. So, and this is honestly, this is the one I've used in practice as a CFO. Most of my career is you reverse it on the first day of the new period, just as nice clean start of the. So I like this method the best. Each of the accounts ends up with the same balance. So if you need to print these slides out and look at them side by side to see which way they fall through, the second is the most common used in accounting practice. So here's your summary of the chapter. It's really the main part about this is making sure that you know how to take that worksheet, get those entries into the books, prepare the financial statements, and then prepare the post-closing trial balance to make sure everything is in balance. The key is to do your statements in order: income statement, then owner's equity statement, and then balance sheet, because you need that ending capital on your balance sheet. All your temporary accounts are closed, so your post-closing trial balance is very stubby, very small. And then reversing any adjustments that you did to start a new period. It's cleaner to do that. If you have any questions, send me an email. Thank you.